Let's just start with your stance on all the uncertainty in the world that we're seeing at the moment and whether you have any answers for us.
This is the hot seat. I'm afraid, you know, if you'd spoken to me 2 years ago when everybody was scared, I think I would have had a lot more answers for you than I do now. So obviously it's a little bit more tricky. I guess what we've done in our funds is two things. The one is probably moved a lot closer to risk-free. Now, I say risk-free. Risk-free is whatever gets you out of the trouble should anything happen in the world, given your set of circumstances. So let's say you have a set of liabilities. You want to move to what those liabilities look like. So that's the first thing. And then the second thing is the trouble over the last little while has presented a lot of opportunities for us, and I suppose that we've started to invest in a lot of those. There's still some gaps. I still think there's some big gaps, but I think you've seen the two discussions before this were very interesting. They're big problems. There's the currency issue, there's the economic issue, there's the emerging market, developed market issue, and all of these I think are creating good opportunities and certainly places to tread lightly.
Jarred, if you look at how fund managers in South, I mean, you see most of the fund managers in South Africa on a fairly regular basis. How would you characterize how they're dealing with the current uncertainty? Is everybody kind of approaching it in a different way, or are you picking up general patterns? In particular, is there any sort of increase in just holding simply cash in the portfolio? And to what extent are guys using their offshore allowance?
Okay, the first thing is that I guess on the asset allocation thing, we do a lot of that.
Yeah.
So we don't really get that involved, but I can talk to some of the asset allocation implications in portfolios. And probably the most important factor that you're seeing everywhere in the portfolio, it is going to be the driver of portfolios, as it was last year and this year coming, is the Rand versus X. And I say X, it could be pound, euro, dollar, but everything offshore. So what you're seeing this in the makeup of the shares. Mm. So there's a big bias, even in your share portfolio, to Rand, let's call it Rand hedges. And that could be quite broad in our market because I think a lot of people have got some kind of business offshore. And then the second thing is most people are gobbled up on offshore lines. It's not quite where it could be. But certainly that is.
And what do you feel about that, the fact that they are so
happy.
Exposed to their offshore lines?
I'm very happy. I would say that as an asset allocator, we're probably a little bit more biased to that because we've added things like Africa into the portfolio. So we're probably sitting at about 30 offshore, closer to what is possible. And that's the 25 regulation plus 5. So I would say we're quite overweight there. Then we probably have a high exposure to value managers, and the value managers and some of the growth managers are very concentrated against the Rand towards foreign currency. So we're more sensitive.
Do you sense that the fund managers or yourself, is this a specific bet that the Rand will come under pressure, that you feel in time the Rand will weaken? Or is it that you feel the Rand could be just trading where it is, but you're finding better opportunity in, say, emerging markets?
Well, I only go back to your comments earlier, 820.
820, I was going to say, let me just put that right here.
No, but I'm not answering the question.
Fair value. Yeah, but 820 is fair value in Kevin's book.
Yeah, and that's why we have that value, because you said so. No, look, the Rand on all the measures, and you mentioned PPP, and let's call it QE2, maybe QE3, whatever you want to talk. The Rand, there's a lot of liquidity in the system. That liquidity is in emerging markets. The carry trade is being done. And the Rand and most other emerging markets, except China, obviously, the currencies are overvalued. So we have that view, and I guess the managers have that view as well. They're building that into their stock forecasts, and they're coming up with portfolios where those foreign currency denominated stocks are looking more cheap than others.
You mentioned that you've got a value bias when it comes to your fund managers that you select. Do you find that value managers are faring well in the current environment? Could there potentially be some room for style drift, given the fact that the growth story is dominant and has been dominant for a long time?
Yeah. Look, I mean, that really is a discussion about value. What is value? And I would certainly hope, and most of the value drivers obviously been out of an Alan Gray, etc. And if you look at an Alan Gray, 10 years ago, their way of looking at shares is probably quite different to how it is now, certainly from what we've seen. So in the early days, we used to just see, look, you go and you buy a high dividend yield, and a little bit more clever than that. And whereas now, I would say they're far more cognizant of not only earnings growth, and therefore dividend growth in establishing a price of value, but I think they're more cognizant of interest rates as well, and I think that's across the board. So I don't know if it's style drift. I think there is some style drift, but I think it's actually the growth managers who are now starting to say, listen, you know,
it's time for value.
Because this is the thing, you know, I think people often mix that model up. When you talk growth, it's earnings growth. So that's the earnings the company earns every year. When you're talking value, it's the price you pay. So they're actually quite different, and they're not mutually exclusive. So you bang down, let's say 10 years ago, you bang down MTN's share price. It becomes a value stock with a high growth. And then you'd see the value managers buying that because it's so cheap, but it would have had this extremely high growth. So it's not mutually exclusive. There is this intersection where sometimes these guys can meet.
Jarred, have you seen within portfolios, have people, I'm talking specifically about fund managers, so not specifically the asset allocation process,
right,
but in terms of stock selection, is your sense that fund managers have become much more short-term in their outlook? In other words, looking as to what could unfold over the next 3 or 6 months? Or do you still think that fund managers have that sort of typical 18 months, 2-year bias in their portfolio?
I would actually say they're going a little bit longer.
Okay.
And you need to for that round call, you know, because it is such an uncertain call. If there's growth worldwide, people chase commodities, rand gets strong. If there's which must be the next big secular change. You'll see growth bob and weave along, but the next big thing must be that we get out of our trouble and start growing. That's my view anyway. But if that's so, then you may well see a stronger rand. So I would say that the guys are saying, let's look actually further, because the rand is overvalued, but when will that turn? 18 months might not be enough, because of where people are, because of where the developed markets are, Europe, USA, etc. So they actually may be looking even longer, you know.
Can I jump in here?
Yes,
because initially you said that you've moved closer to risk-free. What are the opportunities in that space as you see them?
Well, remember that our primary asset base is, our client's primary asset base is pension fund and life insurance, not so much the short-term insurance and medical aid. So it's good, they've got long cash flows. So with inflation links, so our clients are probably the biggest holders of inflation-linked bonds. And you've seen how those have done over the last month or so. So that's done a lot better than the bond story. I guess our clients own 70 or 80% of those.
Of inflation-linked
bonds through the country. But then linked to that, obviously, there's a currency issue. And so they also have moved as far as they can offshore. And everything is generally about this inflation view. So in fact, if you want to look at it more clinically, where you can, because you can't always, move towards risk-free, and where you have a risk in the portfolio, become more diversified. I think that's the way we would look at it. And the one key note there is that diversification, people always say when markets come under pressure, correlation goes to 1, so you get no diversification benefit. That's so until you bring in currency. So if people run away to the secure safe havens, they move out of the South African rand. I mean, that there, or other risky currencies. And
risky assets in total will
exactly.
Be
so equities will
depleted.
drop everywhere. But if the currency goes, then you get some protection by holding that offshore diversification. So I wouldn't look for a one correlation just when you cross the currency divide, in which case I think you get quite good.
And I'm picking up a very cautious stance from you.
So it's more cautious, but you know, you must understand that our clients in early 08 were 09 were probably the biggest buyers of credit and equity. Everywhere around the world we bought tranches of credit where you could buy them at next to nothing, both locally and abroad, and we moved quite heavily into equities where indeed trustees were comfortable to do that.
A very quick closing question from you.
Just
Mr.
quickly,
Mengs.
how would you characterize the local equity market in terms of valuation, ignoring the rand component to it?
Yeah.
Overall, what would you say in terms of value?
Worldwide, fair value, let's just say, and because I don't have a strong view,
Sure.
but that's in the face of cheap offshore markets. And just by the way, offshore markets, I don't know if I have time, but offshore markets, there's, you know, I've just been to Hong Kong and there's some amazing things that are happening. So big differences in valuation, financials in China versus consumer goods. Everybody's going for the consumer goods story. So you're seeing P's are 40, whereas financials in China, they're just not looking good. The property story is not looking good. In India, etc., these things aren't looking as good as they were. And so you're seeing P's are 5. I don't know if the value might be trading the other way, but those are still, if you look at that, there still is some sort of value, especially relative to local markets.